Rob, thank you for coming on the Mindful Multifamily show and podcast. I'm so excited to just get to chat with you today. I know we've chatted briefly at a couple conferences, and guys and gals, I just want to let you know he has a wealth of knowledge when it comes to underwriting at such a young age. Definitely very inspirational. You're definitely not going to want to miss this. So make sure you pause about 30, 40 minutes of your time to really soak up all this knowledge he's about to give us. Rob, thank you for being on.
Thank you so much for having me in the intro.
You're welcome. Rob Beardsley has acquired $40 million worth of value-add multifamily real estate as a founder and principal of Lone Star Capital Group, a New York City-based private equity firm. He has underwritten more than 750 deals and has published over 40 articles about underwriting, capital structure, acquisition strategies, and capital markets. Additionally, Rob advises emerging sponsors on underwriting and capital markets through his Green Oaks Capital Family Office platform. I'm very excited to dig deeper into your bio, your background. Rob, how'd you even get involved in multifamily? Who opened your eyes to multifamily investing?
So back in college, I was going to school for computer science, and I figured, well, I'll maybe start a startup, or I'll work at a consulting firm in technology and make a lot of money. And then once I've made a lot of money, I'll invest in real estate, and that's how I'll grow a portfolio. And that's the smart thing to do. And so while I was studying computer science on the side, I was just reading a ton of books on real estate, and participating in the Bigger Pockets forums and listening to the podcasts. And on top of that, I come from a real estate family. My family's involved in brokerage sales, investment, and so it's a natural fit having lots of conversations with my dad about the business. And he too had his eye on multifamily because we both saw it as a business that was very scalable and made a lot of sense as a long-term wealth goal. So really early on in college, that's when I started opening my eyes to multifamily and dragging my dad into it, and really pursuing different networking events and trying to meet everybody and learn as much as I could.
Very nice. I love to hear that you did it at a very young age, and you soaked up all the knowledge possible in regards to multifamily, so you can get to where you're at today. So you've acquired over 40 million. How many properties is that?
That's across 5 different assets, 4 of which we were the Lone Star as the main principal and sponsor operator, and then a few others that we're a co-GP, and we raised JV equity.
Very nice. Very nice. Let's talk about that first deal. How'd you come across that first deal? How'd you find it? And then everyone loves to know, and I know a lot of people struggle with this, but how'd you come up with the equity?
Right. So our first deal was in the Houston market. It's a 261 unit Class C garden style value add deal. We were chasing after an off market portfolio on this street in Houston where the 3 assets were lined up. This was a 1,000 unit portfolio, so we were very ambitious and new to be pursuing a large acquisition. And in the end, we bid around 49 million, and the ask price was just out of reach, so that deal didn't end up happening. But along the way of driving up and down these streets and getting to know all the brokers that are familiar with the area trading these deals, we came across an off-market deal right next to one of those portfolio assets. So this was a true off-market opportunity. It was recently bought out of foreclosure, and it was a institutional private equity group that had bought a large portfolio of foreclosed assets, and they just bought this deal, put a little bit of money in it to just barely pre-stabilize it, and then they were looking to just flip it. They were managing a big portfolio of 23 assets, so this small 261 unit deal wasn't really a main concern for them. They were just looking to get out, and so we definitely bought it at a modest discount, if it were to have gone to market. And then obviously we were able to capitalize on the fact that it still had a long ways to go to stabilization, deferred maintenance, very poor tenant quality, and lots of renovation upside. So that also led to us being able to acquire at an attractive basis and really have a strong projection for the returns. And I think, without those strong projected returns, taking on a deal of that size as our first deal would have been very challenging. So I think that's part of the reason why it took us so long to find our first deal, is we really had to be sure of our first deal.
Very nice. Yeah, I know a lot of people say this, and I know from previous experience that it is extremely true. Your first one's always the most difficult one. Well, I take that back. Not the most difficult one, but it is going to be a big hurdle to jump over when you acquire that first deal, and then when you get out there to do your due diligence and start raising money. When that first process, let's explain that. Let's walk us through that first deal. How was the due diligence? Anything come up in the due diligence? And then how was raising the money? Because I know a lot of people want to know raising money, how to raise money, where'd you get it from, who'd you partner with?
So the due diligence process was fairly smooth. We were actually very fortunate to have the management company we were working with at the time had a existing full due diligence package on the deal, because they had a buyer that had came in and looked to purchase the asset prior. So we, even though the ownership group it was a year since that report, so that the current owner had spent money and gone, done some more work on it. So it was in a bit better shape than that report. We had that report, which gave us extreme confidence to put up a lot of hard money and to go aggressively after the deal, because we felt that we knew the extent of the skeletons of the asset. And then I'll say the one thing that we, got hit with or made a mistake was we didn't do the best job of verifying notice to vacate units. So, their rent rolls were showing up with, oh, well, this unit's occupied, and the rent roll looks okay, but pretty much right at takeover, we had a fair amount of units that we didn't expect to be needed to be either evicted or that they were going to vacate, and so we had to deal with more initial vacancy than expected.
Yes, and I see that a lot, and that's actually recently happened to us as well. Is we just acquired a property; it was 100% occupancy, and right when we acquired it, 4 units were actually left unoccupied. So yeah, it's definitely good to do a thorough check of the rent rolls with your property manager to make sure these people are actually paying what the rent roll says, and that they're actually occupying these units, and when are their leases up. Make sure you definitely check on that. So I know you said that property's in Houston. What markets are you in?
So our main focus is Houston. We really like Texas as a whole. I think a lot of people share that. Texas is very hot, but it's also very competitive. So we tend to stay away from the hottest major markets of Texas, that being the DFW Metroplex, Austin, and even San Antonio, actually, which is surprisingly very hot. And Houston is also very hot, so it's not like we've got this gold mine of deals in Houston that nobody knows about. Houston's very hot, but we just feel a bit more comfortable in that market and think that the prices trading there are a bit more realistic for us. So we like that market, and then we like the tertiary markets all throughout Texas. So the smaller markets that exhibit similar growth fundamentals as the major markets, but are overlooked and have less investor demand.
Yeah, very good. Very good. Definitely. One thing I want to touch on too, and you'll hear me say this, and I know Rob will say this too, because we've chatted about it when we were at conferences together, is that to find that first deal, Rob and his team built strong relationships with the brokers in that area. And then he built strong relationships with those property managers to leverage it. If it wasn't for those strong relationships, do you think you would have found that off-market deal?
No, definitely not.
Yeah. So you got to build those strong relationships. It's extremely important too, and that's phenomenal. So after that first deal, how was it once you closed? I know you said there were some vacancy issues and everything. What was your business plan for that deal?
So our business plan was to lease up the property to market occupancy, raise rents via interior renovations, which we're actually slightly exceeding pro forma on where we thought we would take rents post renovation. So that's really, really awesome. We're getting almost 20% rent increases. And we've been fairly successful with bumps along the way, but through stabilizing and leasing up the asset. And that's pretty much it. It definitely hasn't gone perfectly. There's been higher expenses. I think with value add deals, especially, the more of a heavier lift it is, the more you have to project uncertainty and more time that it takes to really reposition the asset. If you're buying a deal that's pretty much stabilized, it's core plus, you don't have to really budget those, a potential drop in occupancy or anything like that. But I think it's wise to do so on the heavier lifts.
Yeah, very much so. Very much so. I like that a lot. So from your bio, we all know you've underwritten more than 750 deals. Let's dig into some of those deals. We all know from underwriting that many deals, we know and we all assume you love numbers and you know it like the back of your hand. And I've even given you a couple deals, and very quickly you've put it back to me in my inbox with very detailed instructions on some things, tearing down that T12 or P&L. Let's go through a couple of deals. What got your eyes open to the numbers underwriting game of multifamily?
Yeah, so I've always been attracted to numbers. So definitely a numbers guy, like you said. And numbers are a critical aspect of this business and really of any business. And I was always fascinated by the way you could simply break down the deal, and because the deal has a lot of qualitative aspects to it, the location and the height of the ceilings and demographic incomes and things like that, and then how do you digest those things and boil those qualitative numbers or qualitative metrics and boil them down into numbers. And so I really like that. And basically you can really stand behind a deal with confidence, say, all right, this is how it's going to look, and this is our business plan. And even simpler than that is just the ability to really assess what the in-place numbers are, because even that could be all over the place sometimes.
Yeah, very much so. I definitely agree. So Rob, if I just presented a deal to you, and we all know you're phenomenal with numbers, what would be that first step that you take to start analyzing and breaking down that deal, to just off the top of your head to say, yes, it's a good deal, or no, it's not?
So I would probably, if I'm limited to just a couple numbers, I'm looking at the T12 to figure out what the in-place performance is. So, and this typically means I'm underwriting the deal kind of from a lender's perspective. And the way lenders look at deals is they'll look at the last 3 months of income, of revenue performance, collections, and then they'll also look at the expenses and adjust the expenses for pro forma or future expectation expenses, as well as making sure that reserves are factored in and an adjustment for taxes. It depends on where you are, but Texas is a big one. Florida is a big one. Those reassessments can really kill a deal. I mean, it's just incredible. I've seen taxes go from 100,000 to 300,000. And we have a deal that is going to be reassessed for another from 300 to 500,000. So these taxes, if you're not prepared, can really crush a deal. So it's good, number one, to see that from the beginning, and then also project an ongoing increase in taxes throughout the whole period.
Yeah, I definitely agree with that. Call the tax assessor's office and get as much information as possible. I know here in the Charlotte area, taxes have went up substantially this year in 2019, and I was underwriting a deal and I knew the taxes were off because I live here, and I noticed the taxes were $149,000 for this particular property. After figuring it out, it came out to around $325,000 increase. And you do not want to make that mistake. That's why you got to know the underwriting, be a professional like Rob is, know the underwriting down to the T, so you don't make that mistake for your investors.
And even if you're, sorry to interrupt,
No,
but
no, go.
if you're an investor yourself, right? It's great to have the tools, to confirm the numbers of the deal yourself and really know what you're getting into.
Yeah, very, very much so. Even as a passive investor, if you love numbers, or if that's not one of your strengths, know someone who does. I'm sure at the very end of this, you can get Rob's information. He'll let us know it. Reach out to Rob. I'm sure he would love to chat with you about numbers and underwriting, and how you can maybe have him maybe on a retainer or something, where you can just throw him a deal that you're thinking about investing in, and Rob will underwrite it and give you his opinion on it, because I know he's very thorough when it comes to it. So, underwriting 750 deals and then publishing over 40 articles. You're a busy man writing 40 articles.
It's something that I used to hate, right?
Yeah.
Back in school, you're forced to write a paper, and that's my least favorite thing. Just sit me down in math and let me crunch numbers instead. But now when it's topics that I'm passionate about, I love to write, and it really helps me get my thoughts on paper. And then it also sparks conversations. You write something, and then people can agree and disagree, and you can learn a lot that way.
Yeah, very much so. Very much so. I definitely highly agree with that. So when it comes to writing articles and analyzing 700 or 750 deals, what is your opinion, overall through the underwriting process of what a good deal and how it's structured looks like to you?
I love this question. So a good deal is always a moving target, and that could be because of the type of deal you're buying or where we are in the cycle. And if we're sitting here today, October 2019, we're very late cycle. We've been late cycle for a while. Yields are compressed across all asset classes. Um, the 10-year is very low. I think the 10-year right now is maybe at 175, 170. So historically, a healthy spread between the 10-year treasury bond yield, which right now is 1.75%, a healthy spread to your cap rate would be maybe 250 basis points all the way up to 700 when it's generous. And if you think about that, 250 over 175, that's a very low cap rate. So deals, just by the nature of where we are in a macro market environment with these very low interest rates, cap rates just have to be low. And because there's so much also demand globally for yield, that's even more demand for real estate assets, right? And so that's just coming to a situation where projected returns on real estate, multifamily is so low that we have to readjust our expectations. And a 15% IRR is a great return. That's
Oh,
a
it's
great,
phenomenal.
right? But there's a lot of people that are still out there saying, hey, if I can't get my 20, I'm not doing the deal. So, I think there's a balance of how do we readjust to these lower returns and still make prudent investment decisions where we're not putting our capital at risk. So I think that's what it's all about, because maybe you can go and get that 20% return, which we have seen and we have done, but what is the risk that you're taking?
Correct. How risky is it?
Yeah, exactly. So I think, to go back and answer your question, 15% for a fairway value add deal is a great IRR. And, you might even accept a lower return if you're in a great location, in a great market.
Yeah, very good. Very good. So for just, we're going to touch on this really quickly for just the new investors who are out there, or maybe the entrepreneurs who are thinking about this. What is a cap rate, Rob?
Cap rate is the net operating income of a property divided by its purchase price. And that's the simplest definition, but then it gets way more interesting and way more complicated. So then you have to ask the next question of, okay, well, what net operating income are you using to make this calculation happen, which is NOI divided by purchase price? And so you could use a million different NOIs. You could use the seller's T12, so trailing 12 months of historical performance, and use that net operating income. You could use the seller's T3, or trailing 3 months. You could have reserves, which are typically $250 per unit to $300 per unit. You could use that. You could include that, or you could not include that. You could adjust for future taxes, because the way I look at a deal is I'll say, okay, the current ownership is paying $200,000 for taxes, and they have a no management fee because they're managing the deal in-house. They're self-managing, right? And I'll look at the deal and say, well, I'm professional management. and they're going to charge a certain fee. And when I buy the deal, my taxes are going to go up. So let's say from 200 to 300,000. So I don't really care what he was paying. I need to know what I will be paying and factor that into my going in or underwritten cap rate. So that's just a few ways that I would adjust a cap rate and make it, what I call an adjusted cap rate or an adjusted trailing cap rate. And then just to get even more nerdy, looking at breaking down a cap rate from like a macro perspective. And some people may find this interesting. Some people may be bored, but a cap rate actually is it's a formula of the 10-year U.S. Treasury bond yield, which is known as the risk-free rate. So what are the returns on risk-free assets plus your real estate risk premium, right? Because we're not buying just a government paper-backed government paper. We're buying actually real estate, which has more risk, depreciation, and more management. So there's that real estate premium there. And then you might be also earning some things like a liquidity premium, right? It's not, you can't just buy it and sell it really quickly. So that's why a cap rate is higher than, let's say, a REIT, right? If you buy a REIT, you're essentially owning real estate also, but maybe you're only going to get a 3% return rather than something potentially much higher. And then cap rates are discounted by future growth assumptions. So some people understand this intuitively, but if you are buying in a market that's growing super fast, you're willing to buy a lower cap rate today because you know your NOI is just going to keep growing and growing. Conversely, let's say you're going to buy somewhere where there's no growth expectations, declining population. Doesn't mean it's a bad place to invest, because if you can buy in at a high enough initial cap rate, could be a good deal.
Very much so. I definitely agree with that. If you don't know cap rates by now, I don't know how easier to explain it, because you explained every single detail to it. We'll make sure we'll get Rob's information at the end of this so you guys can reach out to him and soak up more knowledge that he is providing. I want to touch on a topic that we briefly touched on, and I know a lot of people have this issue, when it comes to a multifamily syndication, is raising money. Now, you have to know the numbers and know the numbers of the deal to, one, feel confident in speaking of the deal, but two, to also sell the deal on to an investor, and then sell yourself in the deal to an investor. So, Rob, let's talk about raising money a little bit. What has been your challenges? How have you raised money for your deals that you've acquired? And what's your thoughts on it?
Yeah, that was very well said, right? Know the deal, know the numbers, and then put yourself out there as someone to be trusted with, and be a steward of other people's capital. And I think as much as we love the real estate, we love the numbers, we love the business, if you don't go out there, make those connections, build those relationships, and you can't raise capital, you're not doing any deals. Doesn't matter how good you know the numbers, how good your spreadsheet, whatever it is, how good your off-market deal is. If you don't have those relationships, you don't have the access to capital, no deals are getting done. So it's a very important part of the business. And I think it really is a people business at that point. And
Yes.
It's all about making those connections, and whatever that means to you. Maybe that means starting your own podcast. Maybe that means going to all your local meetups. Maybe it means going to conferences, writing blogs and articles. Whatever that means, it's do it consistently. And I think that's the key to, over time, grow those relationships. It's pretty unrealistic to expect that you can build one of these businesses overnight, because so much of it is dependent on trust and track record.
Yes.
Which can be very frustrating when you're starting out, because it's like, well, if I don't have a track record, I can't raise money, and I can't raise money if I don't have a track record. And so it's not easy, but in the long term, that's the way to go.
Yes, I definitely agree. One thing yesterday, I was on a podcast he left yesterday in a webinar. I said, Warren Buffett, if you Google his net worth, he made, 98% of his net worth after he was 56 years old. This is a long-term game, just like what Rob said. You can't make money, or you can make money overnight, but you can't this is not a get rich quick type of game. This is a long-term game. So know your numbers so you're confident in the deal and that you can speak confidently to an investor. And then the biggest thing, and you even said this before when we first started, Rob, is that you built relationships. I know, and I always highly recommend when you go to a conference, instead of shaking 100 people's hand, shake five people and go really deep with those five people. Maybe narrow that down to 2 to 3. Go extremely deep. The last conference I was at, Rob and I had fries and a club sandwich till like 11 to 11:30 at night talking about real estate. We were just chatting about it. We went extremely deep in the relationship. So go deep into those relationships if you're going to conferences, if you're reaching out to people on social media, because this is all about a relationship type of business to grow depending on where you want to grow your business and your company.
That's perfect. And to add on to that, our good friend Dan Hanford once
Yes.
told me, he said, whenever he goes to a conference, he's looking to, number one, learn one thing that could potentially change his life or business, and number two, meet one person that could potentially change his life or business. So that's totally in line with what you're saying. I think that's a great idea.
Oh, 100%. Rob has changed my life and perspective on how to underwrite and analyze a deal. And I am going to be his best friend for the next 100 years. So, so build those strong relationships. And I know you and I have built those strong relationships with people like Dan Hanford and a lot of other of those big name multifamily guys out there. And it's extremely important to add value as well. Rob is adding value to more than 750 deals that he has underwritten for syndicators and operators out there. He's added that value to them, which they know he knows what he's doing. So it's extremely important to add value to those individuals so you can get in the same room as them as well. So, Rob, I want to finish up here some 6 questions that I always have for all of our guests on the show, because I like to I want our audience to dig deeper into you as a person and to try to get your personality out. So, where do you see yourself in 5 years?
In 5 years, I see myself still living in New York and growing our uh, real estate private equity business. Hopefully had by then bought and sold 1,000 units a few times, and with a growing portfolio that we hold for longer term. I think the big, I mean, 5 years is not all that long, but I think the vision is, the next step is, how do I grow an actual business and hire people who I can train and become basically me, and replace me and duplicate my efforts, because I see that capital is great, and capital is a great way to leverage debt and everything like that, but human capital is one of the biggest resources, and also one of the hardest to manage and create manage with, or magic with, I should say.
Yeah, very much so. I definitely agree with that. And I can't wait to see what 5 years has in store for your company. I know it has big and wonderful things coming to it. So I'm very excited to be alongside of you as a great friend of yours and see where we go in the next 5 years. What is one thing you do on a daily basis to grow your knowledge?
So I try to read as much as I can, and sometimes I don't read as much as I want to. Other times I'll find a book that I can't put down. But I think reading has been one of the biggest factors in my learning, and then giving me the confidence to go out and talk and meet people, and excel at what I do. And I've got book recommendations online that I can share, but definitely need to add to that, because there's new books that I'm reading that are amazing every day.
Very much so. I know our last question is about that. We won't get to it right now, but Rob did at the conference recommend a book to me that I've already finished about investing. He's a numbers guy now, so it's all about the financing on investing, which definitely opened my eyes to everything, because it's always good to look back just at the basics of your type of business or your type of career, because we get so wrapped up in the growth mode. I like to say that we're always trying to grow, but there's always good times to just look back and say, okay, what are the basics of the foundation of this business, of this company, so you can, wrap your head around it and never forget about that on that growth stage that we're all taking. What is one advice would you give another, let's say, entrepreneur or real estate entrepreneur that would be in your shoes, right when you first got started, right now, what you know now, what would you give your person?
I would say be eager to do. And we all want, like you said, growth mode, do. So be eager to grow and do, but um, don't be so eager, to just jump into things. And it's a delicate balance, because then I'll say almost the exact opposite. And I'll tell the people that are just waiting to get out there, they'll say, well, I need to get the perfect business card, and then I can go and do this, or
It's
what?
that fear.
It's the fear, right? And so I think you will grow so much faster if you put yourself out there. And I remember one of the most beneficial phone calls I ever had was an hour-long call where I was able to discuss a deal with a managing director at Cushman on the capital market side. So he knows underwriting like nobody else, and he knows the actual application of it and what the real world people are doing with it. And so I sat there and basically let him tear my model apart and say, you need to fix this, you need to add this, you need to change this, why are you assuming that? And it's just, I couldn't take notes fast enough. So that, I wouldn't, if I were too scared to talk to him and say, you know what, I need to make sure my model's crisp before I talk to him, or make sure my numbers are just right, then I would have missed out on that opportunity.
Two things that I really want to point out to you guys is that, one, the failing is not the biggest failure of an individual. It's them doubting themselves. Them doubting themselves to take that next step, to step outside of their comfort zone, to see what that success sits and what it lies. Now, as an entrepreneur, you always have to embrace rejection. And that's one thing that Rob just said he did, was he threw it out there and said, okay, tear it apart. And I'm the exact same way. I was reaching out to someone on Facebook just to connect and add value. And he thought I was trying to sell him something, and then blocked me on Facebook. It didn't hurt my feelings. Okay, that's fine. If you don't want to be nice today, that's okay. But you have to embrace that rejection, embrace criticism, and embrace someone else's opinion on your business. It may not be true, but still embrace it, because they may be seeing it from a different angle. So you should always take that into opinion and just throw it out there. Just like Rob said, you got to throw it out there and accept that feedback that someone else gives you on your business, on your underwriting. So I definitely applaud you with that. That's phenomenal. And I know you'll definitely keep doing it. So when you do not, what do you like to do when you're not working? I know you and we work 7 days a week, 24/7, but there is a little time in there that our body and our brain needs rest, other than sleeping. What do you like to do?
So I try to get in the gym every day. Lately, it's been tough.
Yeah, I know.
Yoga at night. And, I kind of consider this a part of life and work, but meditation is huge.
I do it every morning and evening.
That's right.
For at least 30 minutes, morning and evening, meditating.
30 minutes in the morning, 30 minutes at night?
Yes.
Wow.
So yeah, I double team it. So I do mine in the shower, because the sound of the water soothes me. So I do 30 minutes in the morning, 30 minutes at night. My morning time is reflecting on what am I going to do to be productive during this day? And then the evening time is, what did I do to be productive? And then what do I need to do? What did I do to be productive during that day? And where's my business at?
That's incredible. Yeah. So that's a huge, now we're talking about work again, but we got distracted off
see. We love work.
But yeah, and then I grew up playing, classically trained, playing the piano. So
nice.
Try to pick that up every now and then.
Some Frank Sinatra?
More like Mozart, Bach, but
Gotcha.
And then the contemporary stuff, blues and whatever's popular right now. But yes, nice. That's pretty much it.
Very good. Very good. That's what I like to hear. All right. Two last questions. One word that describes you.
All of them are cliches, so can't miss, but driven.
I love it. I know you are extremely driven, very driven. If you guys get a chance to meet Rob, follow him on all social media platform, Rob Beardsley. If you get a chance to meet him, just get in front of him, shake his hand because he's extremely knowledgeable, and you will see and feel how driven he is. I love it and love to surround myself with people like him so we both can drive because we both have, I know Rob and I, we haven't digged into it, but I know we both have the same goals in mind because he's surrounded himself by some of the people I've surrounded myself. So just get in front of them. I'm telling you, it will change your life. A good book that you recommend. I know you have a list of them. You pulled it out when we were at the conference.
Yep. So, and I recommended it to you when we were there, but I just recently finished Clockwork. Can't remember the author's name, but he wrote also Profit First. Haven't read that one, but Clockwork is such an eye opener. And, you know, as an entrepreneur, if you do not take those steps to automate your business and systematize it, it'll forever be a job and it'll never turn into a real business. So I've got that fear driving me behind me that, hey, I need to turn this business from a solopreneur or job situation to I'm actually running an enterprise. So that's a huge, I thought that book was great.
I agree very highly with what you just said. And I have not read it. I just wrote it down, but I'm sure it does talk about time management in there because as entrepreneurs, I know when you are doing anything during the day, everyone thinks you have all the free time in the world. So I have now implemented from 9 to 5, no one bug me. I'm in my desk working. And after that, I do work multiple hours before and after that. But that is my time. That is my zone where I am off hands. I cannot do anything. So as an entrepreneur, time management is very important. Rob, you have given us a ton of knowledge, a wealth of knowledge. I'm very excited that you were able to make some time to come on here. If anyone would like to get a hold of you to just talk to you about underwriting, to send you some deals, and hopefully you guys can work together in the future, what is the best way for someone to reach out to you?
So you can reach out to me at rob@lonestarcapgroup.com. And check out the website, lonestarcapgroup.com. You know, articles, resources, and obviously contact me directly. I can share with you my underwriting model and anything else you're looking for.
Sounds good. There you go, guys and gals. You heard it from himself. That's how you reach out to him. Thank you so much for listening to the Mindful Multifamily Show and podcast. I hope everyone has a productive day. Thank you so much.